Good morning, class. This is a class about liquidity, which means cash. If someone were to say to you, I am highly liquid, he means he has a great deal of cash. The first priority of a nonprofit is to remain liquid. That is, have enough cash on hand to meet a nonprofit's obligations. No matter how good an operating budget a nonprofit creates, the nonprofit can still have a serious liquidity issue. That is, a nonprofit can run out of cash and not meet payroll. But they could still have a balanced budget for the fiscal year. If you were to ask me what was the most important priority of a nonprofit ED, I would say to make sure that the nonprofit is liquid. Let me tell you a true story about a nonprofit running out of cash. I was co-teaching a financial management class at the City University of New York on a Wednesday night. My co-teacher, we will call him Alex, came into the classroom before class and said he probably wouldn't stay. He had had a terrible day. Alex was the executive director of a very large nonprofit in Brooklyn with a budget of over $15 million. His finance officer had come into his office in the morning and said that he didn't have enough cash to meet payroll on Friday. Alex was shocked. He said, "How did this happen?" And the finance officer went on to explain that he had been expecting a large multi-million-dollar payment from a federal contract, and it had not come in yet and wouldn't come in until next week. Alex decided to call his board president, who was a vice president at J.P. Morgan. He dreaded making the call. He was so embarrassed. He called, and the board president said he would gather together the board's executive committee, and they would meet for lunch at his office at 12, and Alex should come on down. The executive committee consisted of the board's president, vice president, secretary, and treasurer. Alex went alone. He thought if he took his finance officer that the executive committee might be quite hostile to him. The executive committee met with Alex, and the group decided that they had to borrow enough cash for the nonprofit so that there would be cash for Friday's payroll and the next payroll as well. They asked Alex if he had a line of credit for the nonprofit. Alex did not. So the executive committee got on the phone and got him a line of credit with a fellow banker. By the end of the day, $500,000 had been deposited in the nonprofit account. Alex considered this the most embarrassing moment in his life, which is understandable. However, his board president did tell him that he thought the board was responsible for ignoring the fact that the nonprofit did not already have a line of credit established. So I asked Alex that instead of his going home, would he stay and tell the class what happened? And we could talk about it. It would be good for students to understand that this situation could happen to anyone. He agreed, and I think he found it rather cathartic to talk to the class about the disaster. The point of the story is that it can happen to any of us. Any of us leading a nonprofit can run out of cash. It is, after all about the timing. The timing of cash flow. Unlike government, revenues for nonprofits, especially donations and contractual obligations, do not arrive in a predictable fashion. And the staff of a nonprofit has to be good enough to know that and to plan for the day when the cash does not arrive on time. In other words, we have to manage our cash flow. Certainly, local and state governments can have cash flow problems, but not to the extent that nonprofits do. Nonprofits face an uncertain future every year. A foundation changes its mind, a large contributor dies, a government contract is canceled. All of these events can wreak havoc in a nonprofit. This is unlike local and state government, in which sales tax revenue may decline in a recession, but some sales tax revenue will still come in. So it is crucial that nonprofits track their cash flow. They must create accurate monthly projections of the amount of cash available and then constantly check to see if those projections are indeed accurate. Part of your homework is focused on creating a cash flow management report. Cash flow strategies. We use a number of strategies to ensure an adequate cash flow. There are a few short-term answers. The first, as Alex did, is to always arrange that your nonprofit have a line of credit with the bank So if the nonprofit runs short of cash, you can borrow from the credit line and pay it back later after the expected revenue has come in. Another strategy is to collect receivables in a timely manner. Receivables are monies owed the nonprofit. So nonprofits must have a very reliable staff member in charge of collecting receivables. This is often a contract or grants manager. The job of this type of manager is to make sure the funding from contracts or grants comes in when scheduled. These are the best strategies for ensuring an adequate cash flow. A nonprofit could be late in paying its vendors and save some cash. Although the nonprofit may have to pay interest, it can pay the vendors when the cash flows. There are other unadvisable strategies. These are long-term strategies that leave the nonprofit in a more difficult place. If the nonprofit has an asset such as a building, then the building could be mortgaged and that cash could be used. Although that will solve the fiscal shortfall in the short term, it means taking on long-term debt. A more extreme strategy is to sell an asset. That's a strategy you can only use once. Lastly, a nonprofit may use is to sell their investments if possible. A permanent endowment cannot be liquidated, but certainly any short-term instruments in treasury bills, CDs, and equities can be sold. Again, the nonprofit gives up assets, and that is problematic because the asset can only be sold once. And then what does the nonprofit do the next time it has cash flow problems? It is best to solve cash flow problems through a credit line. Sometimes the nonprofit has a different issue. They have short-term cash, too much of it. A nonprofit can certainly have idle cash. Cash it may need in 3 months, but not this week. Idle cash can be invested in short-term investments. When a nonprofit decides to invest its cash, it needs to consider 3 things: safety, liquidity, and return. A balance must be achieved among all 3, and the first consideration when selecting an investment instrument is safety. For short-term investments, nonprofits should not be investing in common stocks. Stocks are for long-term investments. Also, a nonprofit needs to ignore long-term investments such as treasury notes that mature in anywhere from 2 to 10 years. Treasury bills, however, are short-term and mature in a year or less. So a good place to put short-term cash is in a 3-month treasury bill. The next concern is liquidity. That is, short-term surplus cash should be invested in an instrument that allows cash to be available on short notice. If the cash is needed in 2 or 3 months, a CD or money market account can be useful and can be attained at the nonprofit's bank. Returns are the interest or yield that the investment generates. Although the first part of the 21st century has low interest rates, that will not continue. So someday there will be higher interest rates and you'll get a better return. But when it comes to surplus cash, safety and liquidity are the driving concerns. The rate of return is the last thing to be considered. Let's talk about your homework. To do the assignments at the end of the chapter on liquidity, this is due next week. In assignment 3.2, you will create a cash flow budget for a preschool. You must assume the event income comes in November and that the fiscal year begins in January. Remember, the board wants to end each month with a surplus of at least $80,000. In addition, you have a new case, the Kalamazoo case, which is due in 2 weeks, and it's an exercise about variances. To get the most out of this exercise, I want you to carefully recreate the templates on a spreadsheet and write down every revenue budget and actual, then the variance amount and whether it is a plus or a minus. Then decide if that is favorable or unfavorable. After that, do the same with each expense in the same template. Remember, all the revenue accounts come first, and then come all the expense accounts, and at the bottom you can calculate the total variance. In template 2, it is all about the ticket price. You are to calculate the quantity, revenue variance, and the price. In template 3, the question is all about the animal food. Again, you are to calculate the quantity, the expense variance, and the price. So then in questions 4 and 5, you draw conclusions and provide your opinion. Do not think you can solve the entire deficit, but you can reduce the deficit. And we will share these ideas on the discussion board to solve the case, or as much as we can solve the case. So that is the end of my talk today. My advice to you this week, when you get your first job as the ED of a nonprofit, make sure that nonprofit has a line of credit with your bank.